All right, let me share with you a great scalping strategy, one that will make you almost consistently profitable on a daily basis. The goal here, in which I talk about on my channel, is to be green on the day. What does that mean? That means that you should be making money, okay, not losing money. I know that you may sometimes get into a bad entry or a bad trade. Well, let's really say this: not so much a bad trade, just maybe you got into the trade too early, okay? And we all know that every trade is not going to work out, and you have to know proper risk management to be able to cut the trades early, or if you're going to choose to allow the trade just to hit your stop and be done, okay? The max number of trades that I end up taking on the day is somewhere between 1 and 2 max, okay? I tend to not take more than 2 trades. The reason why is because the more you engage spending time entering and exiting in the market, that's when you will blow your accounts or multiple accounts. I'm sure a lot of you probably have, kind of struggled with that from time to time, dealing with issues of funding your personal account, or maybe passing a prop firm evaluation, and then trying to continue down that path to where you can take withdrawals, right? And it kind of gets frustrating. I know if you're going the prop firm route, because they have their own set of rules. That's the thing about trading your own personal account and trying to grow that, is that we stick to our own rules. We make our own rules, and that's part of our trading plan. Now, the strategy and how I actually trade all centers around multi-chart confluence. What am I talking about? Basically, I'm using top-down analysis, starting with a higher time frame. So whatever that is for you, whatever higher base chart you're using, whether it's on time charts or tick charts or volume charts. For me, I'm trading range charts. It's all the same. We're all looking for great opportunities to trade, looking for areas where the market, or I should say the banks and institutions, are placing their orders, where they're leaving footprints behind to where the market is either aggressively pushing to the upside or aggressively pushing to the downside with momentum, okay? Now, the strategy goes like this. Start with the higher time frame. Figure out the structure of the market, okay? Mark up your first zone off of your higher time frame. So if you're bullish to the upside or trending, then look for a pullback to a key area of demand. Mark it off on the higher time frame, okay? Then from there, what you want to do is scale down to a lower time frame, which will be, whatever chart you may use. I use a 24 range chart. And I know a lot of people that are part of the Discord community have kind of converted and started using range charts. And, there's no really rhyme or reason other than the fact is, for me, I can see momentum coming into the market. It's easy for me to read the candlestick charts versus looking at the time-based charts, and not trying to bash anyone that trades, using time charts, just strictly using or following range charts. I don't have to worry about all the large body candles, all the small or the large size wicks, things of that nature. Everything's kind of consistent when it comes with the flow of the range charts. Now, again, like I said, you start by marking off your higher time frame chart. For me, it's a 120 range chart, but you have to understand structure. That is the most important part of trading, no matter. I don't care what you trade, what strategy you trade. Structure is everything, because you have to understand which way to trade, right? Form of bias. Why would you want to be trading against a moving train when the market is, bullish? Why would you want to be trying to go short? Okay, I'm not saying you can't counter trend trade, but you got to understand those types of setups. You have to scalp real quick and get out, because if the market is moving in one direction overall, bullish to the upside, and you're going short, at some point you're going to get stopped out and probably stop pretty hard. All right, so let's take a look here. Let's see. You see right here with the market on the higher time frame chart, it's my 120 range. It's moving to the downside. Clearly see it making lows, lower highs, moving like that. That's the flow of the market. It's either moving higher or lower. So if it's moving to the upside, it's making higher highs and higher lows. To the downside, opposite of. Here we see it moving lower, okay? Then it makes this low right here, and then this is where we get that bullish momentum push to the upside, where it's making these highs, higher lows, and you can see it pushing higher. Now, there are areas or places on the chart where you may have like a major high or a major low, and even minor areas of structure, okay, in between a leg. So this would be like this is the highest point the market made on that bullish move to the upside before it became bearish. That's a major high. This is a major low. Any and everything in between are going to be what I like to classify minor areas of structure. Okay. So where the market made its first attempt from this bottom portion of this leg here, where it made a high, higher low, and broke higher, you can see that it did what? It broke above structure to the upside. So we got our first high. It broke structure here, came back and made a higher low here, and then it made a higher high. Yes, this is a nice area of demand directly off the higher base chart. But I'm going to cover a demand zone up here too, even though this is right here, because we want to mark off on the higher base chart the zones first. So structures everything, determine the direction. Then mark off a high probability zone on your chart. Okay, and what do I mean by that? Is there a gap attached to the actual zone? Just for reference right here, if you take a look here, you see that last bearish candle to the downside here before the market broke structure? The gap is attached on that, I'll blow it up even more for you, that bullish candle right there. The next candle that closes above, since we're looking at the space or the imbalance between the top end of this bearish candle and the gap on that bullish candle right there, and then the next candle, we see that there's a gap in between right there. So if we mark off our zone this way, that's a high probability demand setup on our higher base chart. Now, we're moving to the upside here. As you can see, we're bullish to the upside. The market, there's a few areas of minor areas of structure as the market is actually pushing to the upside here, like right here, I got them marked off for you already. So you can trade based on the market breaking above minor areas of structure and looking for a pullback to a key area of demand, okay? Or you can simply go with the flow of the market as we're breaking structure higher, like right here, broke structure, pullback, demand. Broke structure, pulled back, okay? It's right below this area here. They were grabbing liquidity, and then the market pushes higher, breaking structure again. Now, then we get a decent retracement here before it breaks structure back to the upside. Now, if you see right here, it broke this minor area structure when it pushed up right here. It broke that area there with that little swing to the upside right there. This is a little demand area right here. So I will look for a pullback to this key area of demand to what? To go long. This is the reason why I have it marked off on my chart. Now, again, I mark it off on the higher time frame to start with and then move down to a lower time frame. Again, moving down to a lower time frame chart from this point. The blue box is that higher time frame demand zone that I marked off just a moment ago. Then move down to your lower time frame chart. It's fairly easy, guys. From there, what you're looking for is the first approach or attempt when the market pulls back. So if we see where the market broke to the upside right here, okay, and it actually took out this minor area of structure over here, and we got a demand zone here. Look at the lower base chart here, okay? The blue box is, again, the higher time frame zone. It makes a high, higher low, and break structure on the lower base chart to the upside right here. We're looking for a pullback, okay, to where it taps into the higher base chart. All right. And also we want to have a lower time frame demand zone. So it's kind of like a zone within a zone approach. As long as the market's pulling back and tapping into a higher base zone off of a higher time frame chart, like right here, it comes back, taps the zone, and we have a high probability 24 range or lower time frame zone, demand zone. You see right here, with a gap attached to it, a very small gap right there. So it comes back to the zone. After it creates a demand zone on the 24 range, comes back to the 120 range, higher time frame zone, then it's tapping into both the blue and that yellow box. The yellow box right there, a rectangle, is the lower time frame. So we got two touches: higher time frame, lower time frame. I'm taking the trade from the lower time frame chart. Now, where do I get into this trade? You can get in aggressive here on the first close of the bullish candle to the upside. You know, where you see this candle here engulfing the body of that bearish candle right there. Right here at 22,181, you can get to the trade right there. More conservative is going to be for the next candle close at 22,185. And we're looking for the market to what? To take out the high here or to fill some gaps or imbalances back to the upside. You can also, let me see here, look over to the left-hand side of your chart, which we can't see it here on a lower time frame because, you know, there's a lot of price action activity. But if we look, not higher time frame, lower time frame, guys, sorry about that. But if we look at the higher time frame, we can see, look to the left to see if there's any imbalances that maybe need to be filled back to the upside. Well, we can see where it needs to fill right here and maybe something above. Well, no, everything else has kind of been filled back in. Okay, so that's really this little small imbalance resting back up here to around about 22,205, 204 area. Okay. So if we get into the trade in this area here, we can kind of aim and gauge for the market to go up there and fill that area. And it did. It went right up there to 205, 206 area. So again, the strategy is determining which way the market moves. Okay. If we are trending to the upside, then mark off a zone, a high probability zone with the gap attached to it. Okay. Or imbalance. Mark it off on your higher time frame chart first, just like I did right here. Okay. Then wait for the market to break above or take out some area structure. All right, it took out this minor swing right here, this minor area structure. Moving down to a lower time frame chart, I'm waiting to see, okay, where, looking for something to happen, basically. Looking to see if there's a demand zone on the lower time frame chart and mark that up as well. So you can see where as it was pushing higher, it pulled back and it made this demand area right here, okay, and it broke structure above these highs right here. Now it's pulling back to both the higher time frame zone and the lower time frame zone, and I'm looking to go long from there. Everybody asks, where do you place your stop loss? Okay, your stop loss is going to go in wherever your lowest zone is, or basically off of your lower time frame chart. For example, like right here, that yellow box right there, it's going to go not at the back end of the actual demand zone. If you choose to do that, then that's okay, but you're going to have your stop loss is going to be a lot larger. Or you can put it right here. What I like to do, when the market taps into our lower base zone, right there at the bottom end of it where it rejects at. So that bullish candle, engulfing candle right there, when the market closes above it, and you enter the market, your stop loss is going to go on the back end here at 22,175. Give yourself some breathing room, about 2, 3, maybe 4 ticks below that area. Because you see right here, the market moves and ebbs and flows. It pushed up, came back. It didn't stop you out, but you may have gotten shaken out, or just kind of, not say stopped out, but you probably were chickened out right here because the market came back and thinking that, okay, it's about to stop me out, and then jump out the trade. That's fine. Nothing lost there because you're, well, maybe a few points or a few ticks right here, because maybe if your break even points right here, maybe it came back against you, maybe 2 or 3 points right there. But your stop is where you really want to put it at, is on the back end right here. All right, and you're aiming for gas to be filled and possibly, first and foremost, this high to be ran to the upside, and then you want to scale behind it. So let's say that we enter the trade right here at 22,180. The market pushes up, pulls back. The moment it breaks structure above this area, or we get the first break right here to the upside, push up, pull back, break structure above this high here, then the stop, which is back here about 2 or 3 points below this swing, below this area right here, we want to move our stop to about right here. So each time it makes a new higher low, you move your stop up, and that's the way you can actually trail. Now, if we look at a supply setup right quick, I'll show you. Okay, now we see where the market made these highs at. We're coming off those highs right there. Okay, and now the market is doing what? It's making lows, lower highs. It makes lows. Okay, so we got the market breaking below this area structure here. Okay, and then it pulls back and it breaks lower right here. So this is a beautiful area, or supply zone right here. Okay, now if I move down to the lower base chart, I'm going to show you right quick. First and foremost, again, structure of the market, right? Making lows, lower highs, breaking structure lower. Okay. Now, what do I need to do then? Then I need to figure out and mark up a higher base zone, because we're looking for a supply setup here, which is inverse of a demand, because the fact is we're breaking lower. Mark off the higher time frame chart, whatever you may use. Okay. Mark it off, and then we're going to move down to the lower base chart. All right, here's that zone right here. Okay, so this is the area where we slightly broke below this area structure right here, had this area of supply right here, high probability because there's a small imbalance back to this actual zone. Okay, there's a gap attached to this candle here, that bearish candle now versus that bullish candle on that area of demand. Now, the market pulls back. We're looking for what? An area of demand now on the lower time frame. I'm down on my 24 range chart, my entry chart, so whatever chart you use. Then when the market pulls back, okay, it's tapping into the higher time frame zone. I'm looking to see where is there a imbalance on a supply area, not demand, supply area. Aggressive selling, gap attached to the zone, it taps into it, rejection, going short. Stop loss goes on the back end here at 22,049 or 50. So, and not just that, here you have multiple confluence there. You have the higher time frame, the lower time frame, and then that half number at 22,050. Half and round numbers are levels that the banks and institutions like to stop at or reject from most times. If you go back and look at your charts, not saying every single time, but most times you'll see them reacting. If they don't reject it, they're going to definitely react at it more than likely. But that's another means of confluence there, or level, that half number, and then they flush to the downside right there. So it's just simple strategy that you can use to be able to look for opportunities within the market. It's best to basically get the overall direction correct using the higher time frame. If you are like trading to say directly off of a lower time frame chart, be mindful what's going on with the higher time frame, because you maybe, like, say, example, tapping into a maybe you're trying to go short, a counter trend, to the overall direction of the higher time frame, and the market pulls back and it taps into a demand zone on the higher time frame, right? And you're trying to go short, well, that's not going to work out for you because the higher time frame is going to carry a whole lot more weight, and you're trying to go short from a lower time frame when it's tapping into a higher a demand zone from the higher time frame. So just be very, very careful with that. That's what I'm saying. Look and glance at your higher time frames, because to make sure that if you whatever trade you're taking, take it with the actual direction of the overall market. But that's what I want to share with you guys today. I go over plenty of setups like this. There's a private community that you can join to where I really go into so much detail surroundings, especially the trade setups that I actually take. If you want to join our Discord, it's actually free. You can scroll down to the description portion of this video. It's the first link there. Click on it. It says Discord. It's free to join. You come over to the trading floor on the Discord channel. That's where most of us are at, sharing trades that we actually take, and myself is just as well. But what I do is I go back and I break my trades down in great detail to the private community. So anyone who's an elite or an ultra elite member, you already know. But what you receive if you are an elite member, and I want to say this, by the way, is very inexpensive. We're only talking $6.99 a month. That's like 24 to 25 cents on the day. Okay. That's very inexpensive. Just think about how much you may spend for those that may drink coffee or, spend on lunch, and how that may add up every single day. Something that only costs pennies on the dollar per month, $6.99. To become an elite member is what you receive are the trade breakdowns, where I go into detail, and there are lots and lots and loads of those videos there that you can watch, to where I break the trades down like you're sitting right next to me. I'm walking you through the structure, my mindset of what I was looking at before I took the trade, leading up to the trade I took, stop loss placement, profit target areas, just giving you the full-on rundown of each trade setup, breaking it down in detail. Plus, you get the video playlist and a great video for anyone struggling with market structure. Now, if you want to take it one step up and become an ultra elite member, you get everything I just discussed. Those three things. Plus, you also receive the live recorded trading sessions and the market recap videos, which is additional video content. The live recorded trading sessions, where I'm actually trading, I'm recording my trade sessions. You can see me take trades as I'm engaged into the market, and I'm talking to you, or talking really to myself in a sense, but making video content for you guys so that you can understand my full-on mindset, because I'm talking through it, through the structure, price action, everything that's going on during the session. So there's tons of those videos just as well. You can become an ultra elite supporter by subscribing down below too, and I'm going to share the link with you in a minute, because it's right below the Discord link. If you go down to the description portion of the video, you'll see another link there that says Ultra Elite Supporter. Click on that. 3 tiers will pop up. Choose either the second one or the third one, the Elite or the Ultra Elite. All right. But the Ultra Elite is $14.99 a month. That's like $49.50 on the day. But again, you get so much valuable content surrounding how I personally trade. Now, I can't guarantee anything, because everybody's perspective and how they're going to read and see the market and trade, and there's so many other things like psychology, and some people are going to get it and some people may not. It just depends on your style and what you're trading and what you're carrying over. I mean, maybe you got some bad habits that you haven't worked out quite yet. Psychology is a beast in itself and something that you have to work on, okay? But this is a very simple strategy. It's very effective, and you can come over to the Discord and ask away. There are people that trade this same strategy every day and are doing very well with it themselves. But outside of that, again, if you want to join the Discord, it's down below. The link's there. If you want to become a elite or an ultra elite member, the link is right below just as well. But if you haven't already clicked on that subscribe button, please take the time to click the sub button. Make sure to turn your post notifications on. If you found value in today's video content, I greatly appreciate it if you drop a like on it. Take care. See you in the next one.